Welcome to Stockgnosis, the channel for long-term investors. In this first video, I want to set a reference point for what I believe makes a truly high-quality company in stock. Share buybacks, dividends, and cash reserves are what separate businesses that capture value from those that simply create it. These are the hallmarks of good businesses and what I like to call monopolistic companies. A true monopoly, or even a near monopoly, doesn't need to constantly fight for revenue. This lack of competition translates into immense financial freedom. It shows up as consistent buyback programs, growing dividends, and balance sheets strong enough to acquire competitors, invest heavily, or aggressively expand into new markets and business endeavors. The opposite is a business in a hyper-competitive market. Every dollar earned gets plowed straight back in just to stay relevant. Margins are thin, reinvestment is constant, and there's nothing left over for shareholders. The airline industry makes this point well. Billions of passengers a year, global routes, genuine economic utility, and yet the industry has destroyed more shareholder value than it has ever created. Competition erodes every advantage the moment it appears. Pricing power is essentially zero because customers leave the second a cheaper option shows up. The value gets passed on to the customers, not the investor. That's the distinction worth keeping in mind. A great business for customers isn't always a great business for shareholders.
So what does a monopoly actually look like in practice? There are three characteristics I want you to keep in mind. The first is brand value and identity. Think about Apple. Apple isn't just a technology company. It's a statement of quality and attention to detail. It sits in this precise sweet spot of aspirational but accessible. It's not Rolex. It's not a luxury product that most people can never afford. But it's also not a commodity. It's middle-class luxury. And the people who buy Apple don't just buy a phone. They buy into a promise of quality, consistency, and trust. Each new iPhone might only be a marginal upgrade, but you know its quality and integrates seamlessly, and it doesn't surprise you in bad ways. That trust, built over decades, is an economic moat. It keeps customers inside the ecosystem and makes them extraordinarily difficult to lose. The second is pricing power, and few companies in the world embody this better than Hermès. There's a counterintuitive truth in business. Sometimes the single best thing a struggling company can do is raise its prices, because price signals value. When something is cheap, people assume it's cheap for a reason. Hermès has spent decades engineering the perception and the reality that their products exist in a category entirely of their own. Their customers don't browse, they petition. A Birkin bag isn't listed on a website with a buy button. You cultivate a relationship with a sales associate, spend thousands on other products first, and wait. The scarcity isn't accidental, it's the product. The numbers make this concrete. Hermès operates at a profit margin of around 42%, more than double Louis Vuitton's parent company, LVMH. While other brands discount to move inventory, Hermès has never held a sale, not once. Their bags routinely resell for 2 to 3 times retail, which means the market is telling you Hermès is undercharging, and they know it. Hermès hasn't just built a better handbag. They've built a brand where being made to wait is part of what you're paying for. The price isn't a barrier to entry, it's the point. The third is the network effect. Meta is the textbook example. Facebook, Instagram, WhatsApp. These platforms become more valuable the more people use them. But more importantly, they become almost impossible to leave. Maybe they do leave to find that other social media platform, but they have no connections like family, friends, or celebrities on that platform, and hence there is no engagement and incentive to stick with the alternatives. The network itself becomes the product, and the switching cost becomes enormous. That's not just user retention. That's a structural competitive advantage built right into the product. Now, the practical question. How do you actually identify these companies before everyone else does? There are 3 filters I'd encourage you to run every company through. The first is customer loyalty under price increases.
This is the real test. It's easy to have loyal customers when you're cheap. The question is, will they stay when you put your prices up? Because if they will, that tells you something profound about how much they value what you're offering. A business that can raise prices and keep its customers is a business with genuine pricing power. And pricing power is one of the most valuable things a company can own. The second is margins and capital efficiency. Look at the financials. Is this a business that runs on strong, consistent margins? Or does it constantly need to reinvest its revenue just to maintain its competitive position? High-margin businesses with low reinvestment needs generate free cash flow, and free cash flow is what gets returned to shareholders. If a company is perpetually capital-hungry, always raising money, always spending just to stay relevant, it's probably operating in a competitive landscape that's eating it alive. The third, and this is the big one, is whether they hold an infrastructure or intellectual monopoly. This is the deepest layer, and I'll be going much further into this in future episodes. But briefly, some companies don't just have a competitive advantage, they own something that makes competition structurally difficult. That might be a patent portfolio, a proprietary platform, a regulatory license, or a piece of physical or digital infrastructure that everyone else depends on. When a company holds that kind of position, it's not just ahead, it's playing a different game entirely. The best investments aren't in the companies working the hardest to survive. They're in the companies that have already won and built walls around the win. That's the monopoly mindset, and it's what we're going to keep exploring throughout this series. So please subscribe and follow for more.